Everyone talks about the Fed setting interest rates, but here's what they don't tell you. One of the Fed's most powerful tools isn't the rate you hear about in the headlines. It's something called open market operations, and it's been quietly shaping your financial life for years. When the government needs money for stimulus, for crisis response, for anything, they sell Treasury bonds. More bonds flooding the market means prices drop and yields rise. That's crowding out. You're competing with the US government for debt, and they have better credit. Here's where the Fed becomes a market stabilizer. Instead of having all those bonds go to private investors, the Fed buys some. This keeps bond prices stable and prevents some of that crowding out from interest rate spikes. Think of it as the Fed saying, we'll be the buyer when nobody else wants to step up. Look at this balance sheet. After 2008, the Fed bought significant amounts of Treasury and mortgage-backed securities. During COVID, this expanded dramatically, dwarfing the previous crisis response. After inflation hit, the Fed switched course. They raised the Fed funds rate and started reducing their bond holdings. But here's the interesting part. Recent data shows they've slowed this process. Notably, around early April, coinciding with new tariff implementation, the Fed appears to have adjusted pace. This is the Fed responding to general economic risks in real time. Even when they're not making headlines about rate changes, they're already stabilizing markets behind the scenes. We're not out of the woods yet. Fed policy is more nuanced than rates up or rates down, and it's critical they have the independence and the trusted data to make the right decisions for the long run. I'm Skylar Olson, and you've watched another episode of In Data She Drops. Subscribe for more real talk on housing economics, and up next and soon, you'll see what economists and the Fed really angst about.